Hello and welcome to these masterclass videos for CFA Level 1 Quantitative Methods. My name's Stuart Jackerman and I've been part of the Kaplan Schweizer tutor team since 2008, and I'll be taking you through these masterclasses. Before we start, just a brief word on how you should be using these masterclass videos. They are designed to be focusing on core areas that you need to take with you as you move out of a topic to the next topic. So ideally, when you're watching this, you've been through the material already. You have an idea of what's there. We're not going to cover every learning outcome statement. What we're going to do is we're going to focus on the core foundational areas that really act as a base for your success on exam day. So real need to know stuff. If you want to cover everything, of course, the module videos are there to cover every learning outcome statement. But in these masterclasses, as the name suggests, we're focusing on mastering core areas which really act as the bedrock to your success in the exam. So you'll have a set of masterclass slides to look at. There are solutions at the back of the slides. So if any of the applications that we look at have been grayed out, there are solutions at the back. Have a look at the back, you'll find the solutions there. And we begin by looking at rates and returns. What you'll see at the start of every module is kind of like a hit list, a summary slide laying out really the roadmap that we've got for the module in front of us. So here, what you can think of, this is like a hit list. This is what we're going to be hitting as we go through the module. All right, and these are the things that you can kind of tick off as we look at them and make sure you're comfortable with the basic definition. Obviously, being quants, we need to apply our knowledge as well. We need to do calculations. Quants is a very important area, as you know, because it's a medium-sized topic, but also because a lot of the ideas and calculations and applications that we do here are applied all the way through, not just the level 1 curriculum, but levels 2 and 3 as well. So this module begins by talking about why we should demand a return from an investment. In its most basic form, an investment is paying out cash today and expecting to receive that money back and more tomorrow, so at a later date. The fact that we expect to receive back more in a future date is it implies that there is an interest rate being earned on our investment or on our deposit, if you think about like a bank deposit. So why do these rates exist? That's the first focus of the reading. So you need to know that rates of return exist because they're compensating investors for risk. That's why we call these rates of returns risk premiums, because if we face a risk or an inconvenience, we demand a return for that risk or inconvenience. So the first two layers of the nominal interest rate that you get on an investment or a security that you've invested in are the real risk-free rate and an inflation premium. So you need to know what they are and why they exist. The real risk-free rate is really compensation for not being able to use your money to consume. You know, we tend to prefer to consume sooner rather than later. So the fact that we've invested and we're deferring our consumption into the future means that we need to be paid for parking our money and not using it to consume, to spend in the shops. So that's where the real risk-free rate comes from, both theoretically and, theoretically it should exist. And empirically, we do find that over the super long term, whilst it might not exist always, over the super long term, the real risk-free rate does exist. If you bolt onto that a premium for rising prices, that's what inflation is, of course, rising prices, what you've got there is the nominal risk-free rate, if you bolt those two together. So just a quick word on nominal. Everything is nominal until you adjust for inflation. Okay, so if I say that an interest rate is 5% over a certain time period, that's a nominal interest rate. If you strip out the inflation that happens over that time, you're left with what you're really earning. The amount of extra stuff that you get, which is a real return outside of rising prices. So all of the returns that we see on our in our financial markets and offered by things like deposits, bank deposits and bonds and things like that, they're all nominal rates. Once you strip out inflation, you get back to a real rate. Put another way, if you bolt on an inflation premium related to expected inflation, rising prices in the shops, onto a real risk-free rate, then you get the nominal risk-free rate. These rates are called risk-free, of course, because they're not associated with any sort of credit risk They're not associated with any sort of market volatility risk. These should be paid under all conditions. Okay, so to get an idea of what these risk-free rates are, we tend to look at treasuries, short-term treasuries issued by governments that have broad taxing powers and also money creation powers sometimes, such that these risk-free rates can be met, making them default risk-free, essentially. If there is any element of default in a loan or a security, the risk that you might not be paid back, you might demand extra return. Once again, that's what these premiums represent, extra returns for facing risks or inconveniences. Liquidity risk, the risk that you can't buy and sell or enter and exit the security easily. If that liquidity risk exists, strictly speaking, it's an illiquidity risk really, but tends to get referred to as a liquidity risk, then you would demand extra return. And if you're depositing or investing for a longer time frame, we tend to demand higher returns because there's bigger risks over longer time frames. That's referred to as the maturity risk premium. So if you bolt these together, then you'll get long-term interest rates. There might very well be other risks associated with other types of securities outside of the types of instruments that offer interest rates and these types of spreads, like equity markets, that sort of thing. But these are the bare bones building blocks of where interest rates on things like bonds and deposits, where they should come from. Incidentally, this nominal risk-free rate, the way I've described it so far, the way we've described it so far, it looks like you just take the real risk-free rate, which is compensation for not consuming, say something like 1%, and you expect inflation to say be 3%. They would bolt together to give a 4% nominal risk-free rate. Actually, these two components, they do compound upon each other to be exact. Don't think the examiner's ever going to try and catch you out with this, but strictly speaking, you should be compounding together 1.01 representing that 1% real risk-free rate and 1.03 for expected inflation. All right, compounding them together and you'll get 1 plus the nominal risk-free rate, which will be slightly more than 4%. All right, because the 1% is compounding on the 3%. Yeah, 1.01 times 1.03 is 1.0403. So there's the 1% of 3% compounding on itself. Okay. All right. So that was a discussion about where returns come from, why returns exist, why we should have positive interest rates over the long term. So now we go about talking about how to calculate returns. And the most simple way to calculate a return on an investment is to simply say, what have I got at the end of the investment? So end of period value plus any cash flow, which strictly speaking, we're assuming is received at the end of the period. So that one there represents the fact that we're investing today for a period and we are essentially assessing how we've got on at the end of the period. This cash flow is income, all right, coming in at the end of the period, time one if you like. That's why they call it 1 there, CF1. So if we take all of our value at the end of the period, which is the share price if you like, plus any dividend, as for example, and you compare that, divide it by what you had at the start of the period, that gives you 1 plus your return over the period. It's called the holding period return. Subtract the 1 and you get back to the holding period return. This is the most simple and direct and straightforward measure of calculating a return. Problem with the holding period return, of course, is that it's not standardized to a given periodicity, if you like. When we quote returns for things like bonds, we tend to standardize and quote returns in annual terms. However, a holding period return is, as the name suggests, unique to the holding period over which it's calculated. In other words, this time period, it's unique to that time period here. All right, so have a look at this. A share is purchased for $10 per share. That's your beginning period price. Sold 3 months later, that's your holding period, for $11. Okay, that's your end of period value. And look at this, having collected a dividend of 0.25 per share. So if we assume we collect that at the end of the period, what we know is that we've got $11 end value, a 0.25 income. If we add those together, we get 11.25. Divide by the 10 we started with, all right, and we get 1.125. And then you subtract the 1 and you'll get 0.125. Remember, 0.125, what comes out of a calculation is a decimal. To express it as a percentage, you'd multiply it by 100 and express it as 12.5%. So that's the most simple measure of return. One of the problems with it, though, as I've already said, is that it's not standardized to a certain period. But we'll be using holding period returns later on to calculate things like time-weighted return. All right, thinking about averaging returns over multiple periods. There's different ways of taking averages. Some, they have different features and some are more useful than others. The most basic way of taking an average, as you know, is the arithmetic mean. It's what most people do when they're asked to calculate an average. Just add up the returns and divide by the number of them. The problem with this from a returns perspective is that it doesn't reflect compounding over multiple periods. If you earn 10% and 10%, take the average, you'll get 10%. In other words, 10 plus 10 divided by 2. But actually, if you invest and get 10% and then 10% again, your original 10% earns 10%, you'll actually end up with more than 20%, won't you? You'll end up with 21% because you earn 10% on the first 10%, which is 1%. So it doesn't reflect compounding. That means it's only really appropriate for single period returns. You might be looking at lots of different securities and averaging the return across, say, a constituents of an index in a single period, rather than thinking about what you'd actually earn over multiple periods. It's the geometric mean, remember, that captures the effect of compounding, because compounding leads to us multiplying together 1 plus the decimalized returns in each period, all right, and then taking that compound total growth and taking the nth root, where n is the number of periods that we are compounding across, okay? Now we'll have a look at how you take the nth root on the calculator. We'll do a calculation in a moment because it's quite specific on the Texas. But once you've done this, what you're really looking at, once you take the nth root, you're really looking at 1 plus the return you've multiplied by on average each period. So if you subtract the 1, then you get back to the geometric average return that you've earned each period, okay? So this does reflect multi-period compounding and is the most appropriate application for an average return over multiple periods. So let's apply this. Let's have a look at this in action. An investment has returns of 15%, that's like R1, 35% R2, minus 25% R3. Calculate the arithmetic and geometric mean return. So arithmetic return, won't spend too much time there, very straightforward. Add them up. I think you get 50 minus 25, which is 25. Divide by 3, you get 8.33. That's fine. The geometric mean return, this is a little bit more, there's a little bit more to it here. What you're going to do is you're going to multiply through, let's bring the calculator up to do this together. You're going to take 1.15, all right, that's 1 plus the first return. You're going to multiply by 1.35, that's the second 1 plus the second return. And then you're going to multiply through by 1 plus R. Now, notice that R3 is a negative, okay? So you're going to multiply through by 1 minus 0.25. So we're multiplying through here by 0.75, okay? And that will give us all of this number under the root sign here. What I've done is the first 3 terms here. What I need to do is now take the cubed root of this to work out what on average I'm multiplying through, what 1 plus R I'm multiplying through by each time. So I'm going to power up, so power up, y to the x, power up, I'm going to type 3, but we're not powering up by 3, are we? You need to remember that the cubed root is the same as powering up to 1 over 3, okay? So we're going to power up, not by 3, we're going to flip that over to get 1 over 3, there you go, and then see what that is. So when we hit equals here, we get 1 plus the geometric return, subtract the 1, and you will get the geometric return, 0.052, multiply it by 100, and you're looking at 5.2%. What do we notice here? We notice the arithmetic mean is higher than the geometric mean. That is something that is true whenever there's volatility in the data. All right, the arithmetic mean, because it doesn't reflect compounding, it's bigger. You know, the geometric mean, think of it like this: geometric mean, because it benefits from compounding, it doesn't need to be so big because interest, if you like, compounds on interest. Okay. Another type of mean considered in the text, and a less well-known type of mean, is the harmonic mean, typically used for ratios. You know, things like price to earnings, which is a ratio, of course, PE. Things like your average cost, which of course is a ratio. Average cost is the total amount you've spent divided by the number of shares you've purchased. These are the sort of things that can be averaged using the harmonic mean. Now the formula is pretty ugly. What you do is you invert your observations. So take 1 over your observations individually and then add them up. And then you're going to actually invert that number and multiply by n. That's what's happening on the top there. We'll do an example in a moment because really it's about applying it in a simple way, I think, for the exam. The other thing is the curriculum makes the point that the harmonic mean, because it inverts with large numbers, it will make them smaller. Like 1 over a large number is smaller and 1 over a smaller number is larger. The harmonic mean tends to give lower weight to extreme large observations and a higher weight to smaller observations. So it will reduce the impact of outliers. Outliers are observations which are a long distance away from the mean, you'll remember. So one solution, we're not saying you should always do this, but one solution to the problem of having outliers in your data, like big observations a long way away from other observations, and you're worried about the impact of those in terms of biasing your statistics, would be to use a harmonic mean. That's just one solution, maybe not always appropriate. So let's have a look at the harmonic mean in action. An investor buys $3,000 of a stock at the end of month 1. That's not actually that important. What's important is that they spend an equal amount of money, which they do, and how many times they do it and at what prices. Because our prices are the X values, all right? So our first price, to get our average price, our first price, X1 is 20. Our second price, X2 is 25. And obviously we're deriving from this that there's 2 transactions, so N is 2. All right, so we've got all the ingredients to get the harmonic mean out now. If you were to just use the formula for the harmonic mean, you'd say an N of 2 divided by the inverse of 20 plus the inverse of 25. Well, that's 22.22. Maybe not immediately trivial how you do that on the calculator. The way I'd approach it is I'd say, well, the inverse of 20 is 21 over. And then I'm going to add the inverse of 25, so 25 1 over. All right. So I did that all in one go. I did 20 1 over plus 25 1 over. Now I've got what's on the denominator. I can put it on the denominator by hitting 1 over again. That's a neat trick. Okay. And then I can just multiply it by the numerator, multiply it by 2, and I'll get 22.22. Okay. So run that back and have a look at it again. That's the quick way of getting that particular calculation out. Do we believe that that's our average price? Because this isn't a massively complex application, is it? I mean, it might, just for our sanity, it might be worth saying, look, if you spent $3,000 at a price of 20, the number of shares you bought in month 1 is going to be $3,000 divided by 20, which is 150. And the number of shares that you bought in month 2 is going to be slightly less, slightly fewer, because you're dividing your 3,000 by 25. All right, so that's I think that's 120. So then you can say your average cost. Now I wouldn't bother wasting time in the exam. This is just for understanding purposes. Your average cost is the total of what you've spent, which is 2 lots of 3,000. That's 6,000 divided by the total number of shares you bought, which is 150 plus 120. 6,000 divided by what would be 270 on the denominator there should be the number we first thought of. And reassuringly, it turns out to be that 22.22. All right, so that's all that equation is doing. So as we've seen, the curriculum suggests we use the harmonic mean if we're worried about the impact of outliers on our calculated statistics, because it lowers the impact of large observations. 2 other more practical measures suggested for dealing with outliers or mitigating the impact of outliers are trimming and Windsorizing. So a trimmed mean, as the name suggests, actually removes data, removes the most extreme data. So we state a percentage, say 1% of our data in terms of the number of values that there are, and we remove the bottom and the top. So we've got to split that percentage into 2, say 2 lots of a half, remove the top 0.5% of the data and the bottom 0.5% of the data. So if you like, if our data's in this range here, if there's the lowest value and there's the highest value in our data, that's a kind of a value line there, number line. What we're going to do is we're going to remove, maybe the bottom 0.5% of data is in here. All right, that's where we've seen 0.5% of the data. We remove that. And the top 0.5% of the data is in here. We remove that as well. All right. Removing data, that's quite aggressive. Data's good. We don't necessarily just want to remove it. So what Windsorizing does is it doesn't remove data, but what it does is it shifts outliers in to a certain threshold. So we substitute values. We don't remove them, but we substitute values at a certain level. So what I mean by that, have a look at this. A 90% Windsorized mean essentially says, look, we're going to keep 90% of our data. So from essentially from 5% of the data up to 95% of the data. If we observe them on a value line again, the lowest is over here and the highest is over there. All right, we're going to keep that 90% data, that's fine. But any outliers that occur outside of these percentiles here, as they're called, the 5th percentile and the 95th percentile, any outliers that lie here, what we're going to do is we're actually going to shift them over and assume they happened here, whatever that value is. So for example, if 5% of the way through our data we've got an observation of, say, 10, a value of 10, we'll make these very low numbers like 2, 3, whatever they are, we'll make them equal to 10 instead of 2 and 3. And up here, if our 95th percentile in our data is like a value of 40, I'm just picking those numbers arbitrarily, we might see outliers of, say, 50 and even like 100, stuff like that. We're not going to actually observe them. We're going to change their numbers and shift them down and give them the same value as the 95th percentile through the data. All right, that's what's going on with a Windsorized mean. So there, we're not removing data, we're not killing data or trimming it. We're just shifting it along to a user-specified percentile. All right. Okay, now a fact that we alluded to earlier, but we're going to just make sure we're comfortable with, and that's how these means stack up relative to each other. We find. Don't forget the harmonic mean inverts numbers, doesn't it? So it makes big numbers small. So a harmonic mean is always less than a geometric mean, and a geometric mean, I should say less than or equal to, right? A geometric mean, and a geometric mean is always less than or equal to the arithmetic mean. We saw that in our calculation earlier on, didn't we? We saw that when we looked at those 3 returns earlier on, the arithmetic mean was something like 8 and the geometric mean was something like 5. Incidentally, if you calculated the harmonic mean of those returns, you've got a negative one, and you shouldn't use a harmonic mean for negative numbers, but that's why we didn't. But if you take positive numbers and you calculate these means, what you'll find is the harmonic mean certainly can't be greater than geometric mean, certainly can't be greater than the arithmetic mean. It's volatility in the data set which causes these means to be different. Okay, what did I do earlier? I sort of said, if you were looking at, say, 2 observations, maybe you've got 5 and 10. They're your 2 observations, right? The average of those from an arithmetic perspective is 7.5. Just add them up, divide by 2. Geometric wise, now if you're not dealing with returns, technically the geometric mean is multiplying things together, then taking the nth root. Here, n is 2, all right? So we're just going to take the square root of 50, okay? So square root of 50, don't know off the top of my head, but it's not too hard to get. Square root of 50, 7.07. So you can see there the geometric mean less than the arithmetic mean. Harmonic mean of 5 and 10, of course, will be 1 over 5 plus 1 over 10. All right, and then there's 2 observations, so 2 divided by that. And once again, just to show you do that on the calculator, 5 1 over plus 10 1 over, all right, equals, that's the denominator. Flip that over to put it on the denominator and then multiply by 2 on the top, and you get 6.67. So you can see that holding. You can see this holding for the harmonic mean being less than the geometric mean, being less than the arithmetic mean, when you've got volatility in the data. If there's no volatility in the data, then all the means will be the same. On now to talk about time-weighted returns versus money-weighted returns. So these are 2 very important calculations that answer your question, what did I earn in an investment, but in slightly different ways. Okay, so a time-weighted rate return is really looking at your average periodic return regardless of the size of the fund. That's what a time-weighted rate return is. In other words, it will give an equal-sized time period and equal weight. Okay, that's time-weighted returns. What you're going to do with a time-weighted return, you may very well be looking at an investment that's got several holding periods. They don't have to be the same length. You're just going to compound together your holding period returns over a certain number of years, and then you take the nth root, where n is the number of years that you've gone across. So for example, if you compounded 4 or 5 periods together, holding period returns over 2 years, you take the square root here to get back to technically an annualized time-weighted rate of return. It really is just an application of geometric means. You're compounding together what you've actually earned in these sub-periods of any length, and then you're working out the geometric compound growth factor. Subtract the 1, you'll get back to really a geometric return. So it's an application of geometric returns here. Incidentally, these holding period returns, they're really dictated by when there's an external cash flow in your investment. So when money goes in or when money comes out of the fund. Those flows in and out of the fund, they're not investment returns. So we need to adjust for those. All right, any money flowing in, we don't treat it like a return. We ignore it, but we do treat it as a starting value for the next period when we use that capital to earn returns. Any money coming out, that's not a loss. We ignore it when we're calculating returns for that period if money came out at the end, but then we subtract it for the start of the next period because we invest a lower amount for the next period. So time-weighted rate of return doesn't reflect, the crucial thing to take away here is it doesn't reflect the size of the fund. That's the crucial idea. It doesn't reflect size. It doesn't punish an investor for putting more money to work just before a relatively bad period of performance, or taking money out prior to a relatively bad period of performance. And you can see where I'm going with this, because actually next up is the money weighted rate of return. And that money weighted rate of return calculation, which is just an internal rate of return calculation, which you can do with your calculator, your Texas, this does reflect the size of the fund. All right, this does reflect size. And so if you do put money to work in your fund or in your investment prior to a suboptimal period of performance, you are going to be punished under the money weighted rate of return, but that's not going to happen under the time weighted rate of return. Now, being an internal rate of return measure, the definition of an internal rate of return is simply the discount rate, which sets the net present value of all the cash flows to 0. So if you take all your cash flows, you've got to reflect the sign. Usually there's an outflow here, and then cash flows come back in later on. Usually, not always, but usually. When you treat this as a negative and these as a positive, and your discount rate is solved for such that you set all this stuff here is really the end net present value, such that you set the net present value to 0, what you're really calculating here is the average return that each dollar has earned, reflecting size. In other words, it will give periods where you've got more invested a higher weight in this average return, average period return. Now, under the formula here, they're making the point that the periods must be equal length. I mean, you're using a periodic MWR here. So if you're going to power up 1, 2, 3, 4, 5, these powers must be relating to a period each, and therefore they must be of equal length. In order to deal with uneven cash flows, cash flows that happen at uneven times, then what you can do is you can divide your period up into short periods with no cash flows in order to deal with that. What that means, and I don't think you'll be doing an application like this, but it's good to know. If you were given, say, time 0, you invested 100, and then on day 14 you invested another 50, and then on day 30 you got back 300. If you were to try and calculate the MWR here, we've got uneven periods, haven't you? This period here is 14 days, and that period there is 16 days. So they're uneven. So what would you do? Well, divide your month. This looks like a month to me. Divide your month up into individual days and say that, on time 0, we had a cash flow of 100 out. This 50 out here, we're going to discount it by 1 plus the daily MWR to the power of 14. In other words, there's kind of like 14 days with no significant cash flow here. All right. And then this 300 here, you discount it by 1 plus the daily MWR to the power of 30. That's what they mean there by using a shortest period with no significant cash flows. By doing that, you can always calculate a small short period MWR and then compound that up to get a longer dated MWR. That's a technical point that I think might get in the way a bit more than helping at this stage. What we should be doing is applying these ideas to calculate a TWR and an MWR, and that's what happens next. This is actually a curriculum example, a CFAI example, and what we're doing is we're buying a share at time 0 for 200. then we're buying another share at time 1 for 225. Okay, so there's quite a bit going on here when you break it down. You're going to have to double up your cash flows in the second period for the fact you've got 2 shares. In the first period, you're going to have to adjust when you think about holding period returns for your TWR. You're going to have to adjust for the fact that we take $5 out of the fund at the end of the first period because we get a dividend and we don't reinvest it. And at time 2, we get another $5 dividend, but we hold 2 shares. So we get $10 coming out the fund, plus we liquidate the fund. We liquidate our 2 shares for $235 each and get $470. So if you think about it, what's happened here from a TWR perspective, when we break out our holding period returns, we've got 2 holding periods, year 1, year 2. They're delineated by the dividends really, because that's money coming out it's money coming out the fund essentially. And we are putting more money to work actually in the second period as well when we buy another share. So that's what delineates our 2 holding periods. In the first holding period, we buy a share worth 200 and it grows to be worth 225 after it's paid a $5 dividend. All right, so it actually grows into 230 in total when we consider the income in the first period. So this dictates our holding period return for the first period. 200 grows into 225 plus 5, which is 230. When we calculate the holding period return for this period, we get 230 divided by 200, so end total value over start value, minus 1, you get 15%. Now in the second period, you start the second period with 2 shares. They're worth 225 each. So you start the second period with 2 shares worth 225, that's 450. And you say, well, what happened to that 5? Well, that got taken out the portfolio, the first dividend, this 5 here, that's gone. We start the second period with 2 shares worth 225 each, that's 450. They grow into something that's worth 470 plus the $10 dividend that we get at the end of the second period. So they actually grow in total to a value of 480. So it's this 480 end value versus 450 start value which drives our second period's HPR. Okay, that's why we see 470 plus 10, that's 480 on the top here, end value relative to 450. Divide that through, subtract 1, and you'll get 6.67%. So the annual TWR here is nothing more sinister than combining a return of 15%, so that's 1.15, all right, and a return of 6.67%, so that's 1.0667. When I say combining, I mean geometrically compounding. And then we're going to power this to 1 over n, where n is the number of periods. There's only 2 years that we span across here, or 2 periods. So a periodic TWR is the square root essentially. You know, the power of a half is the same as the square root. From a calculator perspective, what would I do here? I'd just go 1.15 times 1.0667. Let's see what that equals. That's my total compound growth. Then I just hit the square root key. All right, and that gets me to 1.107. I can then subtract the 1, and I'm staring at the decimalized periodic geometric return, which is your time-weighted rate of return. Okay. Now the money-weighted rate of return is going to be different. It's the internal rate of return of the cash flows which reflects the size of the fund. Think money-weighted. It's sometimes called dollar-weighted as well. So before we go on and just calculate it, you know, like a machine, think about what we're going to see. You know, we had 2 periods here. The first period returned 15% and the second period returned 6.67%. So this was the good period and this was the bad period, you know, relatively speaking, right? That was the high one and that was the relatively low one. So the investor put more money to work, chose to put more money to work in the second period. They held 2 shares in the second period, whereas they only held 1 share in the first period. Now, the time-weighted rate of return doesn't care about that. The time-weighted rate of return is just really an equally weighted geometric average of 15 and 6.67. It's the money-weighted rate of return which cares about the size of the fund, money-weighted, right? So it's going to give a bigger weight to this second period, which is the relatively bad period. It's only 6.67 instead of 15. Okay, so on that basis, I know the money-weighted rate of return is going to be less than the time-weighted rate of return, which just equally weights the 2 periods essentially on a geometric basis, on a multiplicative basis. Okay, So that's a qualitative comment that you might need to make in the exam. You can see that the money weighted rate of return is going to be lower here. How we actually calculate it, we're going to use the cash flow worksheet of the calculator, and we're going to focus on cash flows. Now remember, in time 0, we bought 1 share for 200. There was no dividend coming in. We're buying a share and looking forward, if you like, it's just paid a dividend that we don't get. We're buying it ex-dividend with relation to the dividend at time 0, if you like. So net outflow of 200 at time 0. Time 1, we buy another share worth 225, but we get an inflow of 5. So the net cash flow at time 1 is actually 220. Okay. Now at time 2, we sell both of our shares for 470. You'll remember we sell both of our shares for 235 each, which gives us a total of 470 plus a dividend of 10. So the total cash inflow is 480. All right. We sell the shares for 235 each, and we get the dividend of 10 on 2 shares. So you're going to calculate an IRR here. Now the slides say that the IRR sets this calculation to 0. And so 200 out, make sure you respect the signs. 200 out today, and then 220 out at time 1, discounted back to today by 1 period, and then 480 in, discounted back to today by 2 periods. If you solve the IRR here, you're going to get 9.39%. Now, it's not a trivial matter solving for that IRR. Imagine most of you are sitting there going, well, how do you do that? Well, actually, in the exam, why don't you use trial and error? You can just punch the keys, right? Your answers will be, in a multiple choice exam, there'll be 3 of them. Try the middle one. They'll be ranked in terms of size. Try the middle one. If it gives you 0, then it's the right answer. If it doesn't give you 0, think about whether you need to raise the rate or lower the rate. You don't need to do another calculation. You can just say, now what did I get? If you use the middle one and you get a positive number, then, this is too big. So what you need to do is raise the discount rate to make it smaller, right? So if C is higher, pick C, all right? It's that sort of enhanced awareness through understanding what you're doing, not just hitting the calculator keystrokes that speed you up a lot in the exam and differentiate you from the pack. Now, we've already said that we expect the MWR to be lower than the TWR. Do you remember what the TWR was? It was 10%, something like that, 10.76. Turns out we were right that the MWR, the money weighted rate of return, giving a higher weight to that lower return in the second period, is coming out at a lower average, essentially, all right, which it does. So we're pleased to see that our intuition holds here. Now, if you are in the situation where you need to calculate the IRR and you can't do it by trial and error, I have drawn out the calculator keystrokes here, so you can do it on the Texas BA2 Plus. All right, so you're going to use the cash flow worksheet, which is this button here. All right, so use the cash flow worksheet. Let's get that out of the way here. Use the cash flow worksheet. CF0 is the cash flow at time 0. So you can type 200. Don't forget to make it negative. Enter that and arrow down. C01 is the cash flow at time 1. That was 220 out, remember, because we bought another share. Whoops, I'll just use the delete button here. See the delete button? It's useful, isn't it? Right, so 220, delete button was there. 220 negative, all right? And then enter. Now, when you arrow down here, you might be surprised to see F01. F01 is saying, well, how many times does 220 go out? Is it more than once? If it is, tell me about it. And then we can just assume that the second type of cash flow is 220 and it happens to say 7 times. It's a way of speeding up. But actually, our cash flow type 1 of 220 going out only happens once. So I'm just going to ignore this. I'm going to arrow down again. It's defaulted to 1. So I'm going to arrow down again. I get C02. What's the second type of cash flow? It's 480 coming in. All right, happening at time 2 here. So 480 enter. And then I can hit the IRR key, which is here. And I can hit compute, top left. And I get 9.39, the number we first thought of. Okay, so that's good. That does work. That gives us a window into how to use the calculator should trial and error ever fail us. But trial and error is always available to you in a multiple choice setup, of course. Okay, on now to an area that's very important for your level 1 quants and indeed for other areas in level 1 like fixed income and so on, and that is the idea of non-annual compounding. So non-annual compounding occurs when we actually pay an interest rate periodically, and that periodicity, if you like, is not a year. Usually it's more frequently than a year. So we have this idea that there's a number of periods that we're applying the interest rate for in a year. We call that M. M because it's contained in the word compounding probably, and C's already taken. There's a certain number of periods a year. So for example, if you're compounding semi-annually, M would be 2. If you're compounding quarterly, M would be 4, and so on. And what gets quoted with non-annual compounding, you need to be really careful with this, because what gets quoted is not a true effective annual rate of return that reflects compounding. It actually doesn't reflect compounding. All we do when we quote an annualized rate, when there's non-annual compounding, is we take the true periodic rate. Like for example, for a 6-monthly return, we take the true 6-monthly return that we would earn, and we just multiply through by 2. So that doesn't reflect compounding, does it? When you just multiply by 2, it doesn't reflect interest earning interest. To reflect compounding, what you'd have to do is to take 1 plus the semi-annual rate and power it up by 2, and then subtract 1. But that's not happening here. So these quoted or stated, sometimes referred to as nominal rates, don't reflect compounding. You've got to be really careful with that. Let's have a look at an example here. Let's say an interest rate is stated, so this is RS, as 8% per year. Now, if compounding is non-annual, you're not actually going to earn 8% in a year. Here we see that compounding is semi-annual, so M is 2. And what that means is, actually what's going to happen is, we're going to take that 8%, we're going to carve it up into 2 parts, and we're going to apply 8 divided by 2, which is 4. We're going to apply that twice. So if you think about what your effective annual rate of return is, which reflects compounding, okay, and given a stated rate of 8%, what you're going to do is you're going to compound by 4% for the first period. That's half of 8. You know, you're compounding, essentially your periodic rate is the quoted rate divided by the periodicity. Okay, so 8 divided by 2 is 4. You're going to compound by 4% twice. Now, when you do this, you're going to end up with, if we start with $1, say, you're going to end up with, well, you're not going to end up with just 8, are you? You're going to end up with a bit more than 8. So you're going to end up with 1.0816. I know it's going to be 16 there because 4 squared is 16. So the effective annual rate of return here, when we compound a quoted rate of 8% twice a year, is to actually leave us 8.16% better off. Hopefully you can see that there. If you can't, subtract the 1 that we started with, and you've got 0.0816, and that, of course, when you multiply by 100 is 8.16%. So that's the true effective annual rate of return for the year, which reflects compounding, all right, 8.16%. So notice how a quoted rate, when we're compounding more frequently than annually, a quoted rate is small, and your effective annual rate, your ear, if you like, is big. I always like to think that compounding gives you big ears, where ear reflects, the compounding, right? So we've just seen, actually this slide is catching up with us a bit. We're saying that if you're quoted a rate of 8% RS, then in order to work out what you effectively earn, including compounding during a year, take the 8 and divide it by 2, the compounding frequency, or the number of compounding periods per year, and you get true semi-annual return of 4%. So your ear is going to be 1 plus that 4% in decimal terms squared minus 1. This is the generalization here. Your ear is 1 plus the periodic rate to the power of m minus 1, where the periodic rate actually is the quoted rate divided by m, the compounding frequency. So the ear here would be 1.04 squared minus 1, and that gives us the same answer, of course, as we discussed when we drew the timeline here on the previous slide. So that's all fine. What do we notice? We notice what we noticed before, and that is, when you reflect compounding, you get more. All right. If you compound more frequently than annually, you earn more than the stated rate. So let's think about what happens now when we increase the compounding frequency with a fixed stated rate. Okay. So let's keep our stated rate at 8%. Right. We're going to fix this. What does that mean from an effective annual rate of return perspective, which reflects compounding? Don't forget. What does it mean as we increase the compounding frequency? Now, trivially, by the way, when you've got compounding frequency of once a year, then your periodic rate is 8 divided by 1, which is 8, and you apply it once a year. So yes, you do actually get the nominal or stated rate as an effective annual rate of return every year if your periodicity is 1. That's a kind of a trivial case. We've just seen that when the compounding frequency is 2, in other words, you've got semi-annual compounding, your effective annual return goes up to 8.16%. We just saw that in the last calculation. What about quarterly? So when M is 4, what we're going to do is we're going to say our EAR, our effective annual rate of return, well, what we're going to earn each quarter is going to be 8% divided by 4. All right, so our periodic return here is going to be 8%, the flat quoted rate, divided by 4, which is 2, obviously. And when we think about our effective annual rate of return, that means we're going to compound 2% 4 times in the year. Okay, so when we compound 2% 4 times in the year, we see that our EAR is 1.02 to the power of 4 minus 1. Okay, and that's how we get to this number here, 8.24%. Just to show you, not that you'll probably need to know how to do it on the calculator, just for completeness, we'll go 1.02 to the power of 4, all right, minus 1. Okay, that's how you do it on the calculator. That's how you get that 8.24. And why don't you have a go at getting these other effective annual rates of return that are about to appear on the slide. The method's the same. Get your periodic return by taking the flat quoted rate of 8%, dividing by the periodicity. So 8 divided by 12 is, that's 2/3, isn't it? What you could do is you could say your effective annual rate of return here is going to be 1 plus 0.08 divided by 12. That's your periodic rate. Okay. Then you compound that up 12 times and subtract 1, and you should be getting 8.3. All right, we'll just check that we can get that. Incidentally, when you've got a little bit more of a complex calculation like this, I'd always go inside the brackets and go to the most complex area and try and do that first. So that would use the fewest brackets in your calculation. For example, I'd go 0.08 here, 0.08. That's your flat rate divided by 12 to see what we apply per month. So there you go, that's that kind of 2/3-ish figure. Then we're going to add 1 to that. So that's me dealing with this number in the brackets. Then I'm going to power up 12 times to reflect compounding. And that's how I get, then I subtract 1. And that's how I get a number very close to 8.3%. 0.082999 is close enough to 8.3 to round it to 8.3. Okay. If it was daily compounding, notice we're increasing M here. If it was daily compounding, then your EAR would be, I'm not even going to bother working out the daily rate. Your EAR would be 1 plus 0.08 divide 365 to the, do that calculation first, then power up 365 times and subtract the 1. Okay, now if you do that, it's the same process as before. If you do that, what you're going to find is you do get a higher rate, but one thing you might notice, so here's me just going through the keystrokes, 0.08 divide 365 is a very small daily rate, plus 1 is just greater than 1, power up 365 times, and we get 8.32, take the 1 off, and you get the exact number. So that's about 8.33, isn't it? 8.33%, and that's what we see here. So make sure you understand the mechanics there. The important thing to take away from this particular analysis is that as M gets bigger, your effective annual return gets bigger, but it doesn't get bigger in a straight line, does it? It goes up, by 16 basis points here, then only 8 when we double periodicity again, then only 8 basis points when we go up, when we triple the periodicity. And look, it's a very small increment in terms of your EAR when we go from monthly to daily. So if we thought about how your effective annual rate of return is behaving relative to your compounding frequency, it does look like, start off at 8 here, does look like it's bounded above, doesn't it? It does look like there's some sort of ceiling above which your effective annual rate doesn't go, because it's going up slower, isn't it? It's going up at a slower rate. We'll come back to that. Okay. So let's take a look at an example. Now, one of the things, before we do this example, I'm just going to say that one of the things the current curriculum does is it does introduce securities, ideas, techniques, which are expanded upon in a lot more detail later on in the curriculum. It does introduce them early just to apply basic TVM concepts. So don't get bogged down here with like, what is a bond? How do bonds work? What are the different types of bonds? Just go with the example. I'll briefly outline what these instruments are, but after you've done fixed income, you'll be a guru on this and you can come back and this stuff will be second nature. Okay, so really focus on the kind of TVM valuation, pricing, rates of return type side of things rather than the instruments. That will be covered later on in fixed income. So what have we got here? We've got zero coupon bonds. So what that means is you've got an instrument, you're holding an instrument that doesn't pay a regular coupon. That's why it's called zero coupon. But it pays a known par amount of 100 euros at maturity, which is in 2 years' time. So when I think about a timeline here, we get nothing at time 1, nothing at all until time 2, when we get a payment of 100 euros. The question is, what should we pay for this bond today if, and all the bond is just a cash flow at time 2, that's all it is. What should we pay for this if the fair interest rates that we require are 6%, quoted on a semi-annual compounding basis? Now that's, hopefully you're starting to see just how crucial this bit here is to the whole calculation, because that changes everything. It's very easy to make a very common mistake if you fail to reflect that compounding. You see, we're not going to compound by 6% a year. Oh no. Or discount by 6% a year. We're not going to do that. We're going to say, look, if this flat quoted rate is made on a semi-annual basis, what that really is 2 times the true semi-annual rate. Okay, we've got a compounding frequency of 2 here. So what we're looking at, 6%, is actually the true semi-annual return. All right, the true semi-annual return multiplied by 2. So we don't get 6% a year. What we actually get is 3% every 6 months. All right, 6% divided by 2. So when you price this bond, instead of discounting by 6% every year, what you're going to discount by is 3% every 6 months. Of course, there's 4 lots of 6 months in 2 years. So we take our 100 and we discount it back to today by dividing through by 1.03 to the power of 4. Okay, and that gets us to 88.85. Just a brief word on the calculator here. 100 divided by 1.03 power up 4 times equals, that gets me the right answer. And it gets me the right answer because my calculator's in the right mode. What do I mean by that? If you didn't get the right answer there, your calculator's in the wrong mode. If you did get the right answer, you can skip this bit. But if you didn't get the right answer there, your calculator's in the wrong mode. To put it in the right mode, go second and then dot. I've got variable decimal places. If you want to copy me, hit 9, enter there, and it will give you variable decimal places on your calculator. Then if you arrow up, this is the calculatory mode, the calculation mode your calculator's in. You want to be in a mode called AOS. Those of you that maybe got the wrong figure there are in the other mode, which is called CHN. If you're in CHN, hit second and enter, and you'll change back to AOS. There's a toggle there. Second enter is a toggle between chain mode, which does calculations in order, which you don't want, and AOS, which does powers first. It stands for algebraic operating system. Powers first, multiplication and division second, and addition and subtraction last. That's the one you want to be in. You want to be in AOS mode. When you're in it, and it shows you that you're in it on the screen there, you can cancel out. All right. Okay, those of you that did get the right answer, you're back in the room. We're going to move on now to another important concept, which is annualizing returns. So the idea here is that we've got different holding periods of different lengths. And what we want to do is standardize our returns to compare them. And when I say standardize, what I mean is show them for the same time period. So the default time period for a rate of return that we standardize to is a year. If you're given any holding period, you can take the holding period return and annualize by putting 1 plus the HPR to the power of what is a year versus the holding period. That's what that power is. For example, if your holding period is 6 months, then you'd have essentially a power of 2 here, wouldn't you? 12 months for a year versus 6 months for the holding period. Okay, so let's apply this. Once you apply this to different returns over different holding periods, you can actually compare the returns, okay, because they're stated on a consistent standardized time frame. Let's have a look at a CFA example here. An investor is evaluating the returns of 3 recently formed ETFs, or exchange traded funds. Selected returns presented below. Right, so the first thing we notice is that they've got different time frames. These Holding period returns, these are the HPRs here, are over different time periods, 146 days, 5 weeks, 15 months. So what you're going to do is standard to compare them. I mean, if you just looked at these, you'd say, wow, look at 14.35, but that's generated over a much longer time than the other two. So to compare them, we need to standardize them from a time perspective. Okay, and the standard time unit, if you like, is a year. That's the default. Time frame or time period. Okay, so with the first one there, 146 days. How do we get to a year? Well, we're going to scale up to 365 days, right? So the power that we apply, here's 1 plus the HPR, all right? 1 plus 4.61% in decimalized terms. The power we're going to apply is 365 days in a year relative to 146 days in our holding period. Okay. Incidentally, to do that on the calculator, you would go, this is one of the rare times I would use brackets on the calculator if your calculator's in the right mode. So you've got 1.0461 to the power of, and then I'd open the brackets and go 365 divide 146. Then I would close brackets and then I would hit equals and then subtract the 1. Okay. So I would use those, I would actually use brackets there, and that's how you get to that 11.93. In a similar fashion, you're going to be looking at an annualized return of 12.05 for ETF2. To get to a year here, to get from 5 weeks to a year, we need to go up by a factor of 52. So that's why we get 52 over 5 as the power. All right. And here we've got 15 months. Actually, we're scaling down there to 12 months for a year. So you'll see the power for ETF3 is actually 12 months in a year versus 15 months in the holding period. Okay, so similar keystrokes to before. I would actually use the brackets. And once you've standardized these returns to be expressed on an annualized basis, you can then just pick the highest one, which turns out to be ETF2. Okay, we're going to return now to an idea we introduced a little bit earlier on in the section, and that is the impact of increasing the compounding frequency. We did see earlier on, didn't we, that if you increase the compounding frequency, so let's have the compounding frequency on the horizontal axis here, you do actually earn more, obviously, because interest earns more interest if you apply it more frequently. So for a stated rate, say here, as we increased the compounding frequency, the effective annual rate of return went up, but it didn't go up in a straight line, did it? It went up in these these marginally smaller increments. Yeah. Now it did suggest that there was a ceiling on top of your effective annual rate of return, the actual return you get in a period, if you compound as frequently as you possibly can. In fact, if we get a mathematician to come along and allow m to get very large, go to the limit, as they would say, in other words, tend towards infinity, we do find that we can calculate this ceiling, that the actual return doesn't have to be for a year, so it could just be a general HPR. The actual return for a period tends towards a certain finite value, a finite ceiling. Now, here we come across something that's very common when we do have things that are getting very, very big or very, very small, and that is the exponential constant. Now, don't be afraid of the exponential constant. It's just a number. It's 2.71828 ... because it's not a nice round number. If you want to see what the exponential constant is, you can always do that nice and easily on the calculator, because there's a function here. See this, the second function of ln, which we'll talk about, is e to the x. If you type a number, let's take the number 1, and then you do second ln, you will see the exponential constant put to that power. All right, so e to the power of 1, there it is, 2.71828, and more noise, right? More digits. So that's all the e is. Don't be afraid of it. It's just a number. It's about 2.7. And what you're going to do to get this ceiling, this limit, is you're going to put that 2.71828, you're going to put it to the power of the quoted rate when we're compounding continuously. When you do that, make sure you decimalize. All right, make sure you decimalize that rate. Okay, the quoted rate, which we're going to call RCC here. It's just a quoted rate like from before, like a stated rate like RS from before, but it's what's special about it is we're assuming we're compounding it infinitely many times, in other words, continuously throughout a period. And then you subtract 1 and you'll get back to what you actually earn in the period. So let's apply this, see how we get on here. Let's say that we've got an annual period, periodicity, continuously compounded quoted rates are 8%, so that's RCC. All right, so that's a stated rate just like before. You might remember, by the way, that when we set M equal to 365 with a stated rate of 8%, we got an effective annual rate of return of 8.33. That's what we did earlier. All right, chances are that 365 is big enough such that we are pretty close to the ceiling that we are calculating here. Okay, let's have a look. Your HPR is going to be the exponential constant to the power of that stated RCC, the stated rate, minus 1. Okay, so keystrokes here, let's just go through them. If you want to put e to the power of 0.08, you type 0.08 on your calculator. Like I say, don't forget to decimalize it. Then do second ln, all right, and you get 1.08328. Okay, take one off and you're back at 8.33. Okay, so yes, that's actually quite straightforward, isn't it? And the important thing is to not worry about the exponential constant as like some sort of ethereal beast that's coming out of coming out of the ether. It's actually just a number. It's actually just 2.71. Okay, all right, and the keystrokes are quite straightforward there. We do need to go the other way. What do I mean by that? Well, and incidentally, by the way, before we move on, you can see that the ceiling is approached very closely when we put a day count, a compounding frequency of 365 in. All right, a daily compounding. We were very, very close to that limit. If you went to more decimal places, you'd see that we're not quite there, but it's close enough, isn't it, at 2 decimal places to be the same thing. We need to go the other way. Now, what do we mean go the other way? Well, if you're given an actual return, we need to somehow get back to what would be quoted on an annualized basis, or what would be quoted on a flat basis, such that when you continuously compound it, you get back to that actual return. So how do we do that? We can see here that our actual return is e to the RCC minus 1. All right. What we need, of course, is the opposite of the exponential function. We can always add 1 to both sides here. So 1 plus HPR is e to the RCC. So that minus 1 disappears because I've added 1 to both sides. Okay, so if we've got a mathematical function that's the opposite of the exponential function, which is putting e to a power, then we could use it here to remove e from the equation. And that's what we do, because the opposite of the exponential function is the logarithm function, ln on your calculator. That's why, by the way, the ln key and the e to the x key are, if you like, complements of each other. So if I just take logarithms of both sides here, the logarithm of 1 plus the actual return is equal to the logarithm of e to the RC. Logarithm and exponential are the opposite of each other. They cancel out. So you're left with this very useful equation. What you need to do here is you need to come away with the fact that the quoted continuously compounded return, like that flat rate that's quoted on a periodic basis, usually annually, is actually the logarithm of 1 plus the actual return that's earned during the period. Okay, let's make sure we can use that. Here's an example. If an investment grows from 50 to 55, what is the quoted continuously compounded rate of return? So what do we quote on a periodic basis? Well, we know that 1 plus the holding period return here, what you actually earn is going to be 55 over 50, which is 1.1. I mean, hopefully it's relatively obvious that we've actually earned 10%. So that's our HPR, all right? And so 1 plus the HPR is 1.1. So our quoted continuously compounded return is just the logarithm of 1.1, all right? And this is super easy. The keystrokes here are just simply, 1.1 and then hit ln. There you go, 9.53. So really simple keystrokes, all right, 1.1 and then hit the ln key, and you will get back to the quoted continuously compounded return. The idea is this stated rate, if you compound it continuously, you get more than that. In fact, you get 10% instead of just the stated 9.53%. A takeaway from here, by the way, is that if 1 plus the HPR is end price over start price, you can always express your continuously compounded returns as simply the logarithm of end price over start price, or end value over start value. Okay, that's an important little shortcut, if you like, that's often used in texts that confuses people because they don't really know where it comes from. It comes from the fact that your end price divided by your start price is 1 plus what you actually earn during the period. And by the way, this is why some people will also call continuously compounded returns log returns, because they're just the logarithm of 1 plus the actual return. Now let's look at a more comprehensive example here. And before we do, let's just actually reflect on something that's often overlooked when we're talking about continuously compounded rates. Most delegates that are meeting this for the first time will be thinking, why? Why do you want to do this? Why do you want to assume that we're compounding continuously? The answer is not a practical one. The answer is more of a theoretical and academic one. Continuously compounded returns behave a lot more neatly when we combine them together, either with different investments or across time periods, particularly over time periods. Continuously compounded returns are additive over multiple periods. That's not the case for actual returns, is it? We've already seen that for actual returns, you have to do 1 plus R1 times 1 plus R2 and then take the square root to work out what you're earning on average each period. That's geometrically combining, in other words, multiplying. Now that's a lot more of a complex mathematical function, compounding together and then taking the nth root for n returns, than just adding them up and maybe dividing by the number of them to get the average, okay? So that's why modelers, people like, Fisher Black and Myron Scholes, these guys, Black-Scholes, they like using continuously compounded returns because they're just a lot easier to deal with when we scale up over multiple periods. They just scale up linearly. You just add them together, okay? Another key takeaway here, actually, is to think, well, if with discrete returns we're multiplying by 1 plus HPR, the holding period return, to go forward in time, and dividing by that to go back in time, which we are, all right, then given that your holding period return is, by the way, e to the RCC, then you can view e to the RCC as simply your compounding factor and your discounting factor. Multiply by it to go forward, divide by it to go backwards in time. Okay, so have a look at this example here. An investment with an initial value of 1,000 has continuously compounded returns of 5% and 3% in subsequent years, in the next 2 years. What's the value of the investment after 2 years? Now be careful. These are quoted continuously compounded returns. They're not what you actually earn. So this is like RCC1 and this is RCC2. So be careful with these. What's neat is that to get the total cumulative 2-year return, you can just add them up. All right, so 5 minus 3 is 2. There's me overwriting a solution which will pop up there. All right, so 5 minus 3 is 2. All right, that's what it says underneath my writing. So that's nice and neat. You might, by the way, there might be people sitting there thinking, yeah, it's nice and neat that you can add them up, but in order to get to this here, you had to do some exponential and logarithm stuff, which we don't like. So doesn't that cancel out this idea that it's simpler to use continuously compounded returns? And the response to that is, well, actually, it's the statistical properties of adding up that are really useful. When modelers are modeling how asset prices behave over time, like Black-Scholes, when they're coming up with their model, actually, if you're making assumptions about daily returns, when you add them together to get, say, weekly returns and then monthly returns, actually, statistical properties tend to propagate a lot more easily. In other words, carry on as you scale up. When you add, they don't hold so much as you multiply together. So that's why the modelers really like these continuously compounded returns. Now, look, this is your 2-year continuously compounded return. This means your future value of the investment after 2 years. We're going to use the compounding factor of e to the RCC. We can take our original 1,000 and we can multiply that through by the exponential constant 2, the continuously compounded return that has been earned over those 2 periods. Keystrokes here would be start with the exponent 0.02. All right, so 0.02 second ln to put e to that power, and then multiply through by the 1,000. Kind of do it. Start at the back and do it going forwards. Multiply by the 1,000, and you see that in actual terms, your investment will grow to 1020.20. Okay, the final section in this reading is to look at the different types of return measures that we could be using when we're looking at, we're thinking about looking at a portfolio manager here. So portfolio manager, if you think about it, they go out, they buy and sell securities. That will give a gross return. Now, a gross return is still, if you like, that's the highest level of return. It's still after trading expenses. You can't separate the costs of trading, like commissions, from the investment strategy. It's not something that you could remove. It's part of the strategy itself, the fact that you need to buy and sell the securities. So just be careful here. The gross return of a manager is after trading fees like brokers' commissions and the impact of crossing dealer spreads, that sort of thing. The net return is looking at adjusting the gross return for the expenses of the manager, the management fees, and the administrative expenses of the fund. Okay, so if you're told about any general expenses of the fund, things like custody, audit, that sort of thing, and you're told about management fees, they would be taken off the gross return to get to the net return. The idea is the difference between the gross return and the net return really reflects the cost of running the fund, and primarily reflects the cost of the manager being paid to run the fund, all right, alongside other disclosed expenses. Now, of course, if you invest in a fund, you don't earn all of that return. You will pay tax on that return. So we might want to look at a post-tax return. Prior to that, we'd call it a pre-tax return. And then don't forget, if prices are going up around you in the shops, which they have been at the time of recording, you don't actually get that real return. If your after-tax return is 5 and shop prices have gone up by 5, then actually you're not better off. So to get to this real return, which tells us how much more stuff we can actually buy in the shops, we adjust for inflation. And we can just, technically what you should do is adjust for inflation in a multiplicative way. In other words, take 1 plus your post-tax return, your after-tax return, and divide through by 1 plus the inflation. That links back to one of the first slides we saw today in this session, and that is what's called the Fisher effect. We're going to use the fact that we've been working in nominal terms prior to this, above this line, all right? So we've been working out what our nominal return is, and actually your nominal return is a real return multiplied through by 1 plus inflation. In other words, if you adjust for that, then 1 plus your real return is going to be 1 plus your nominal return divided through by 1 plus inflation. That's technically what you should do there. You can get away with just subtracting inflation from the nominal return as an approximation when you've got small numbers. Also, we might be using leverage in our portfolio or in our investment. If you are, then you're going to think about what your return is on the dollars that you've put up, the money that you've put up, rather than the return on the underlying assets. And that's referred to as your leveraged return, the percentage return on investors' funds. So we're going to demonstrate these by looking at a CFA example. Now, this is our first example where really it's not really the sort of thing you'd see in an exam. It's a lot more verbose and wordy. There's a lot more to it, but it's still good from a masterclass perspective. It's still good to go through these things and to make sure we can really apply the knowledge that's really crucial for the exam. So here we've got Mr. Lowrum analysing the returns of the Rhine Valley Superior Fund. Okay, so in the first year, fund starts at 30 million and has a net return. So that's after fees and expenses, like general fees and expenses, all right, of 15% for the year. So that's pretty good. It's a pretty good return, isn't it? In the 5th year, the fund reports a net investment return of 3%. Okay, that's after fees and expenses as well. The fund spends a fixed amount of 500,000 euros every year on expenses that are unrelated to the manager's performance. All right, so it doesn't matter, these aren't performance fees. These are fixed expenses that have to be paid. And we would assume that these are management fees and admin expenses, all right? That's the default assumption. Trading expenses come off of the gross return automatically. So we're looking here, when we're told about explicit expenses that a fund suffers, we're assuming we're talking about general management fees and administrative expenses. Mr. Lowrum has been concerned, or has become concerned, that taxes and inflation reduce returns, which they do, of course. He pays 20% tax, and inflation's about 2%, and we expect that to continue. Right, so what have we got here? Well, start with go with what the question asks you. Always look at what the question asks you first. Estimate the annual gross return for the first year by adding back the fixed expenses. Okay, so if there was any doubt that these fixed expenses were general admin expenses, things like, auditors' fees, custody fees, things like that, then that doubt is put to rest by saying we've got to get from our net return to the gross return by adding back the fixed expenses. They even tell you what to do. So we know that the net value of the fund at year end, we know that the net return for the first year was 15%. So we know that the net value is going to be 30 mil, what we started with, multiplied by 1.15 to grow it to a net value of 34.5 million. The gross value, of course, before we took off the $500,000 of expenses, don't forget the fixed expenses here are 500,000. So the gross value therefore must have been 35 million, and therefore the gross return is end value of 35 million divided by start value of 30 mil minus 1, which is 16.67. Now, one thing that comes through here, and this is more for later levels than level 1, the solutions to questions are usually a lot more straightforward than what the question makes it look like. So that's the thing about CFA. Throughout the whole of your CFA journey, you should always be focusing on really just making sure that you apply the basics to what can sometimes look like really nasty scenarios, particularly at later levels. Okay, but that's fine, isn't it? That's absolutely fine. What's the next thing we need to do? Okay, so a little bit of chat here. The gross return for the year is higher by 1.67%, which actually is the 500,000 as a proportion of the 30 mil that we've added back, of course. So what's the next thing we've got to do? What's the after-tax net return for the first year? Okay, so we know the net return was 15%. We were told that. We were given that in the question. Applying a 20% tax rate, all we need to do is take the 15 and multiply it through by 1 minus the tax rate. And we get to 12. Once again, very, very straightforward, a lot more straightforward than what the question suggested. Next up, we get asked, what's the real return? So what we do is we punish our nominal after-tax return. Everything we've done so far is nominal. We punish our nominal after-tax return for the fact that, you remember, inflation was expected to be 2%. Okay, so we're going to punish our nominal after-tax return, which incidentally, we're talking about the 5th year now. All right, so that's important to note. We're talking about the 5th year. You might remember in the 5th year, we were told that the fund has a net investment return of 3%. All right, it might be useful to, well, it's very useful to remember that because we're talking about the 5th year now. So first thing you do, you know that the net return, I'll just write that on here, is 3%. First thing you would do is you'd adjust for taxes. All right, so there's us applying a tax to a net return. All right, and we get 2.4%. And then inflation is going to erode that 2.4% even further. So remember, we're going to go with multiplicative returns here. We're going to take 1 plus the nominal after-tax return. And we're going to divide through by 1 plus inflation. All right. This is harking back to the relationship I wrote up here. This is called the Fisher relationship. Okay. What you get in nominal terms is actually a compounding of real returns and inflation. What you demand in nominal terms should be real and compounding your expectations for and your requirements for real returns and your expectations for inflation. Reverse engineering this, 1 plus your real return is 1 plus nominal return with inflation stripped out by dividing through by 1 plus inflation. If you subtract 1 from this, you'll get back to the real return, of course, and that's what's happening here. Real return is 1 plus the nominal after-tax return of 2.4%. divided through by 1 plus inflation. All right, subtract 1 and you get back to a paltry 0.0039 or 0.39%. Notice that we are applying adjustments for taxes first and inflation second. You do need to do it in that order, otherwise you'll get it wrong. Taxes first, because you pay your taxes on your nominal returns, okay, and then you think about in your post-tax return how much more real stuff you can actually buy. All right. You know, the tax authorities apply your tax bill to your nominal returns. They don't apply it to your real returns. So you need to do taxes, apply to nominal returns, and then do the inflation adjustment afterwards. Right, the final type of return we need to consider is your leverage return. So leverage comes from borrowing. All right, that's what leverage means. Leverage or gearing, it all comes from borrowing. There are 3 different names for the same thing. If you think about leverage using a lever, you're magnifying forces. Gearing magnifies forces. Gears magnify forces. So that gives you a window into what borrowing does. Borrowing magnifies your percentage rates of return on your capital. because you're increasing your exposure using someone else's funds, right? The assets that you're exposed to are bigger than what you could afford with your own money. Now, you've got to be careful here, all right? You've got your assets that you're investing in your portfolio. And what we're saying here is they're not all funded by yourself. You've got to be careful because the funds that the investor puts up is referred to as the investor's equity. And you need to view that as not shares, but that's the investor's own funds. What we're looking at here is kind of like a mini balance sheet, which you'll become familiar with as you go through the accounting section of the CFA Level 1 curriculum. You know, these assets have been funded partly by the investor putting their own funds up, what's called VE, the value of their equity, and partly by some borrowings. So we'll call that VB here, the value of borrowings. So you might have $100 of assets. You might have only put up $20 yourself, and therefore you've borrowed 80. All right, that's the kind of big idea here. Now, the fact that you've increased your exposure means that not only do you earn the return in your portfolio, so whatever these $100 earns, not only do you earn that, let's say they go up by 10%. All right, so they've gone up by 10 trivially on 100. Okay, not only do you earn that, but you also get a return. You also earn the excess return that the portfolio earns over your cost of debt. Say that's cost of debt is say 3%. You also earn that net 7% on essentially this multiple, how much you've borrowed relative to how much you've actually put up. So in this particular case, you'd be earning 10% plus 80 over 20, lots of 10% minus 3%. Okay, that's me just doing these numbers quickly. What have we got? We've got 10% plus 4 lots of 7. All right, 4 lots of 7 is 28. So I've actually got 38%. So there is your leverage, your gearing, right? We've gone from an unlevered return of 10% up to a geared return of 38%. And so why are your returns magnified? They're magnified basically because you've got $100 of exposure, which is earning 10%, but you've only put up 20. So you're getting, incidentally, useful throughout the rest of the curriculum will be to just acknowledge the leverage multiplier here. Leverage multiplier is the value of your assets relative to the value of the equity that you put up. It's called VE here, all right? And so the value of your assets is 100 and the value of your equity is 20. You've got 5 times leverage here. And we've got quite a big cost of debt, 3%. That means we don't scale up from a 10% return to a 50% return directly because we are paying a 3% cost of debt. But it's that order of magnitude, isn't it? We're going from 10% up to, closer to 5 times that level. All right. So let's make sure we can apply this formula. Incidentally, this formula, it might not immediately sit in your pocket. I like things that stick. They might not be the most sort of neat way of expressing things, but I like things that stick. So my leverage return, the way I think about it is you get all of the return from the portfolio. All right, so RP times the value of your assets, you'll get all of that. All of that's yours. Take off your cost of debt. So whatever your cost of borrowing is. So RD is your cost of borrowing. It's a little r, isn't it? So let's make it a little r. Little RD multiplied by your value of your borrowings. Okay, that's what it costs you for your borrowings. And then express this dollar gain. This is now a dollar gain as the value of the equity that you put up. Okay, so that will give you the same answer. And I prefer this method here because it's a lot more intuitive. If we have these numbers again, my assets earn 10% of 100. So that's obviously 10. All right, and then I need to pay a cost of borrowing of 3% of 80. All right, so I need to pay cost of borrowing of what looks to be 2.4. And then I need to think how big that net gain is relative to my equity, which is 20. I find this a lot more intuitive. We've got 10 minus 2.4 as a fraction of 20. And when we work out what that is, obviously we've got 7.6 over 20. All right, so that turns out to be the same number as before. And I just find that a little bit more intuitive and less reliant on, there's your 38%, all right, less reliant on an arcane formula that you feel you need to learn but you don't really understand. Yeah, so I prefer this method here. And if I apply my method to this situation, see this here? We've got an equity portfolio. Now be very careful That's not the investor's funds. These are your assets. Turns out the assets are shares. All right. So your assets are valued at 5 million. So there's your assets. And they earn a return of 8%. So that's the return of the portfolio, unlevered. If the portfolio uses 3 million of borrowed funds, that's VB. At a cost of 4%, that's the cost of your debt. What's the leverage return of the portfolio? So using my simple method, I'd say, right, your leverage return is going to be everything you earn on the assets. So your assets have earned 8%. That's your RP multiplied by 5 million. Minus what you pay for your debt, your dollar cost of debt, which is 4%, 0.04 of the value that you borrowed. So we've borrowed 3 million. Okay, and then we're going to divide that by the value of the equity that the investors put up, the investors' own funds. Here we've got assets of 5, all right, and we know that we've borrowed 3, so the investors' funds must be 2, all right. That's kind of like the start of accounting, where your financing here equals your assets. Okay, so the value that investors have put up here is 2, all right. So a very straightforward approach here. Let's not clutter this up. 8% of 5 million is 4, of course, minus 4% of 3 million. All right, so I'm going to make sure I'm trying to do this in my head, but I'm going to make sure I'm not going to mess this up. So 0.08 times 5 is 0.4. All right, and then we're going to minus 0.04 lots of, so 0.04 lots of 3, and then we're going to divide that by 2. All right, so we get 14%. Now, if you apply the formula, which is a little bit arcane, you'll get 14%. If you take your RP and you scale up by the value of the borrowings relative to the value of equity, and you look at how much your portfolio has beaten your cost of debt, all right, then you will get 14. But once again, a little bit of a tip for you as you go through the rest of the whole of the CFA curriculum. I see delegates year in, year out creating lists of formulae, and that's great. But when they start learning those formulae verbatim like a parrot and relying on just kind of chanting them in the exam room mentally, that's where I worry. So, by all means have your lists of formulae, but make sure you get behind them. Understand what they're doing. This formula is just neatly summarizing this idea. As much as we can, we'll be trying to get behind these formulae rather than just stating them and using them. Okay, well, that completes the first module of Quants CFA Level 1, the masterclass. Make sure that you can do all the calculations that we looked at. They're all very crucial, as is the case with these masterclasses. They're all absolutely crucial calculations, must be able to do. Once you can do all these calculations, you can move on to the next section.